What if I told you that the way the global economic system functions is almost indistinguishable in structure from a scam? That every so-called responsible act you've been taught to do, putting money into savings, contributing to a pension, faithfully making your mortgage payments, is not just about you managing your life, but is part of a mechanism that requires a constant inflow of new participants beneath you, channeling money upward to keep the whole thing standing. This isn't limited to one illegal fund or one shady operator running a fraud in the background. This logic is the core operating model of the modern financial world. And here is the uncomfortable truth. The reason it hasn't already buckled is because governments, private banks, and central banks actively keep it alive by supplying constant new credit, constant new entrants, and constant new narratives to justify it. This structure can't stabilize and just sit there. It has to expand or it begins to fail. So the real question isn't, could it break someday? Because anything that demands never-ending expansion in a world that is finite will eventually hit resistance. The real question is, when the break comes, who takes the hit and who gets sacrificed to cushion everyone else? To reach that point, we have to define exactly what a pyramid scheme is without softening it. A pyramid scheme is straightforward. It promises unreal levels of return, the sort of payout that sounds impossible in normal markets. And it dresses that promise up as if it's safe and repeatable. But behind the surface, it doesn't create genuine wealth. It doesn't generate lasting value. It keeps itself alive by taking money from later participants and using that money to pay earlier participants. That is the entire machine. Charles Ponzi became famous in 1920 for doing exactly this. He told people he could pay them a 50% return in only 90 days. In the beginning, it seemed to work, because when early investors asked for their payouts, he paid them exactly what he promised. That early success created the illusion that the system was stable and brilliant, and that illusion is what drew in a flood of new money. People lined up to give him more cash because they believed the first round of payouts proved it was legitimate, proven, and safe. But the underlying math was merciless. Each new layer had to be bigger than the last layer. To keep delivering those same huge returns to people who got in first, more and more new people at the bottom had to pour in even greater sums. Within months, the model had scaled to a point where it couldn't feed itself. It imploded, and thousands of people were left bankrupt. Ponzi himself ended up in prison. His name survives as the shorthand for this kind of system. But the important lesson is not just that it failed. The important lesson is why it failed. A pyramid scheme cannot run forever because it depends on infinite growth. It always needs more new contributors than the round before, in a world where more eventually stops being available. When the supply of new believers dries up, the structure tears apart. Now, here is the disturbing overlap. If you strip away the legal wrappers and polite terminology and you focus only on how capital actually circulates, the global economy follows that same basic logic. Look at what is actually happening around you. Governments take on trillions in liabilities, not out of cash they already earned or value they already created, but by borrowing against the tax revenue of future generations. People who haven't even entered the workforce yet, and in many cases, people who haven't even been born yet. Corporations take out huge volumes of debt and then use that borrowed money not mainly to increase long-term productivity, but to buy back their own stock, which drives up share prices and enriches executives and shareholders in the present, while the cost of that leverage is moved off into the future. Ordinary people are kept on an intravenous drip of credit cards, auto loans, student loans, and mortgages that last decades, paying interest for years and years while barely shrinking the total they owe. And then we get to the question nobody is taught clearly. What is this money everyone thinks they're dealing in? It is not something backed by gold or silver or anything tangible you could demand and hold. It is created the moment a loan is issued. That's the part almost nobody is openly told. The bills in your wallet and the number you see in your account are not there because someone printed that exact pile and set it aside in a vault for you. They exist because a bank extended credit and essentially called that credit new money. Under a system known as fractional reserve banking, when you deposit $1,000, the bank is only required to keep a small portion of that deposit, for example, 10%, locked up as reserves. The remainder can be loaned out. The moment it's loaned out, that loan counts as new money circulating in the system. The borrower can then deposit that borrowed money at another bank. That second bank also keeps only a fraction and lends out the rest, which again becomes newly created money. So, from that first $1,000, the financial system can multiply the total amount of money and debt claims into several $1,000s. On the surface, everyone appears wealthier, balances grow, asset prices inflate, people feel richer on paper. But in reality, this structure is just layer on top of layer of promises, overlapping claims, not solid assets. It is a stack of IOUs arranged like a pyramid, and it stays upright only as long as almost nobody demands full redemption at the same time. The second that collective confidence weakens, people rush to withdraw, banks face runs, and the system starts to seize up. When that happens at scale, what you get is cascading bank failures and emergency interventions, the same basic crisis pattern the world saw during the Great Depression, and then again in 2008 when the modern credit structure tied to housing snapped apart. This didn't just appear recently, there's a historical path. After World War II, the post-war financial order was built around what became known as the Bretton Woods system. Under Bretton Woods, the global monetary structure was organized around the US dollar, and the US dollar itself was linked to gold. That gold linkage created the appearance of an anchor, a sense that there was some physical restraint holding the system in check. But that architecture ended in 1971, when Richard Nixon effectively shut off the ability to convert dollars into gold. That moment severed the last tie between global currency and a hard backing. From that point on, the entire system ran on fiat money, currency that has value because governments declare that it has value and because people collectively accept that declaration. Fiat currency is based on belief, and belief can crack. So, to keep that belief from cracking, governments found themselves needing to make a perpetual promise: permanent growth. They had to keep reporting expansion, keep projecting rising output, keep telling citizens and markets that tomorrow would always be bigger than today. That growth, more and more, was manufactured through debt, through inflation, and through the conversion of human labor into the fuel that props up the numbers. In plain terms, the system as a whole now depends on non-stop expansion, funded by borrowing, by money creation, and by extracting more of your time and your effort. That is the same internal logic as a pyramid. It survives only as long as it keeps getting wider at the base. Take the example of pensions and Social Security programs. People are taught to believe that the money they pay into these systems during their working lives is being stored for them as an individual balance and will later come back to them in retirement. That's the story. The reality is different. In practice, the benefits retirees receive are paid using the contributions of younger workers who are paying right now. In other words, the money flows upward from the currently working generation to the generation that has already exited the workforce. That setup functions only on one condition. There must always be a broad, steady base of younger contributors who are numerous enough and productive enough to fund the older layer above them. But in advanced economies with aging populations, countries like Japan, Italy, and also the United States, the demographic base is eroding. You have a shrinking number of young workers paying in, and at the same time, you have a growing number of retirees who have been promised payouts. The obligations owed to retirees expand, while the inflow from active workers stagnates or even declines. The numbers stop adding up. That's what makes it a demographic version of a pyramid. Once the shape of the population stops widening at the bottom and starts inverting, fewer young paying for more old, the structure becomes mathematically unstable. Governments respond in predictable ways. They issue more debt and they create more currency. They put temporary patches over what is really a structural imbalance. But each patch just pushes the true cost into the future and makes the eventual gap bigger, not smaller. Now, look at the housing market. For a long time, home values in many developed economies have not primarily been justified by underlying usefulness, rental yield, or productive output. Instead, those values have been justified by what the next buyer down the line will be required to pay using leverage. Every housing boom is fueled by a new wave of buyers coming in underneath, stretching themselves with larger and longer mortgages, just to gain entry at all. The idea of property always goes up depends on the constant willingness of newcomers to take on heavier debt loads. But when affordability breaks, and in many places, affordability has already broken, the pool of new entrants at the bottom contracts. Fewer households can qualify. Fewer households can carry the payment burden demanded by inflated prices. When the base thins, the structure above it loses support. At that point, the myth that a house is guaranteed, ever-rising wealth shatters. The supposed equity people believed they had can vanish quickly. What looked like safety gets revealed as exposure to leverage. Lifetimes of payments can suddenly be seen not as ownership, but as participation in the same pyramid dynamic. You only win if someone after you is willing to take on even more. The same pattern shows up across financial markets. Stock valuations are not determined only by measured current earnings or by patient analysis of long-term cash flows. A huge part of pricing is driven by the expectation that someone else will buy those same shares for more down the line. That mentality, that your profit depends on finding someone willing to pay higher than you did, is embedded in the structure. Crypto makes this dynamic even more naked. In crypto, the earliest adopters and biggest holders become extremely wealthy only if a surge of later participants believes in the token, buys the token, and drives its quoted price higher. The logic is transparent. The top benefits if enough people pile in after. But it's a mistake to pretend that this approach to value is just crypto. The truth is that this logic exists throughout the modern financial system. The expectation that profit depends on a continuous arrival of new buyers willing to absorb higher prices is not an edge case. It is standard behavior. And when the structure begins to fracture, when it becomes clear that the lower rungs can't keep carrying the load for the upper rungs, that is when the real overseer of the modern pyramid steps in, the central bank. In 2008, when the housing market buckled and the financial products built on top of mortgage debt started collapsing, the Federal Reserve and other major central banks intervened by creating trillions of dollars. The formal label for this was quantitative easing. But what that meant in practice was simple: inject massive amounts of newly created money into the system to prevent it from imploding. Old obligations were rolled over and honored using fresh money that hadn't existed before. Enormous private losses were transferred away from the people and institutions who caused them, and were instead spread out across the broader public. Meanwhile, the profits made during the boom years stayed with those who had already extracted them. The structure wasn't allowed to fall. It was rebuilt, but now even more dependent on artificial life support. And the bill for that rescue landed on you. It arrived in the form of weaker purchasing power for your savings. It arrived in the form of higher costs of living. It arrived in the form of austerity and public pressure to tighten belts. It arrived in the form of taxpayer exposure to debts that weren't yours. Your position in the system absorbed the pain, so the upper layers could remain intact. You can see this cycle repeated through economic history. The South Sea Bubble in 1720 lured investors with glowing promises of profit from trade with South America. People poured funds into those promises and were devastated when the structure imploded and wiped out fortunes. The Great Depression of the 1930s came after years of speculative excess and leverage that then collapsed violently, taking savings and livelihoods with it. The asset bubble in Japan during the 1980s pumped real estate and equity valuations to absurd levels. People repeated claims that land in Tokyo was worth more than all the land in California, and then it all fell apart, throwing Japan into what became known as the Lost Decade. These are not unrelated historical curiosities. They are evidence of a repeating pattern. Each one was an arrangement that depended on continuous inflow, continued confidence, and ever-rising valuations. And each one broke when that inflow stalled and that confidence cracked. The common thread is obvious once you see it. These episodes are all systems that needed constant injections of new money and constant waves of believers to maintain the appearance that the numbers were sustainable. Eventually, reality intervened, and the math could no longer be stretched. Over time, we've learned to normalize that behavior. We don't call it a pyramid when it's written into official policy or traded on major exchanges or defended on television by respected experts. We call it growth. We call it stimulus. We call it the economy. But if the entire thing demands relentless new borrowing, relentless new debtors, and relentless new confidence just to remain upright, then maybe it is not a real foundation. Maybe the entire thing is built on an unstable base, and maybe people like you and me are the foundation layer holding it up with our work, our time, and our savings. As of now, this structure is taller than at any previous point. Global debt is estimated at more than $300 trillion. To put that in perspective, the combined IOUs of nations, corporations, and households are roughly 3 times larger than all the goods and services the world produces in a single year. In other words, humanity as a whole would need to dedicate about 3 full years of total economic output just to climb back to zero. And still, when you listen to politicians, mainstream economists, and central bankers, the proposed path forward is always the same. Take on more debt, call that growth, and borrow from the future to patch the holes in the present. Everyone at the top understands what that means. It is the logic of a Ponzi-like structure that nobody dares actually shut down. Because if the flow of new borrowing slows, if the steady drip of new entrants weakens, the entire frame risks collapsing under its own weight immediately. So, instead of stopping, they accelerate it. That is also why inflation bites so hard. Inflation is how the structure quietly collects its payment from the base. Prices do not climb only because of supply disruptions or shifts in demand. Prices also climb because every time governments run deficits and spend beyond what they take in, and every time central banks intervene to stabilize markets or absorb losses, new money is injected into the system. When money is created faster than real value is created, the money already in circulation loses power. Your wages lose reach. Your basic savings and cash lose strength. Your promised pension shrinks in real terms. Inflation is not treated as a freak accident by this system. It is treated as the price of survival. It is how the pyramid keeps itself standing one more round, by quietly transferring the cost onto you, the normal participant who has no choice but to pay it. Demographics make this even more dangerous. Social security and pension structures in Western economies are built on the assumption that younger workers will keep supporting older retirees. But birth rates have been falling, and life expectancy has been rising. People are spending more years in retirement, drawing benefits for longer, while at the same time, there are fewer young workers entering the system to fund those payouts. The base of the demographic pyramid is shrinking precisely where it needs to be the strongest. In Japan, more adult diapers are sold than baby diapers. That detail is not just a curiosity about culture or lifestyle. It is proof of an economic imbalance that is getting worse. The same pattern is visible across Europe, and it is increasingly visible in the United States. These retirement promises are structured like a pyramid. Money flows upward from active workers to retirees. That works only while there are always enough new workers feeding the base. Without constant new contributors, the promise breaks. It becomes mathematically impossible to pay everyone what they were told they would receive without either cutting those promises, borrowing even more, or creating even more money. And this instinct to rescue the system, no matter the cost, has only deepened over the last century. Every major crisis has produced the same type of answer. The Great Depression produced the New Deal era, along with a dramatic expansion in direct government involvement in finance and an embrace of fiat-style money management. The oil crises of the 1970s produced what became known as petrodollar recycling, where oil revenues were routed back into U.S. Treasury debt to keep global liquidity flowing and keep the machine turning. The financial meltdown of 2008 produced trillions in quantitative easing, where newly created money was injected directly into the financial system to hold it together. The 2020 pandemic response used the same playbook, but at a scale the world had never seen before. In each of these cases, the solution was not to admit that the model itself might be structurally compromised. The solution was to reinforce it. The solution was to double down, expand the pyramid, layer on more debt, and delay the final reckoning so that someone else in the future would be forced to absorb it. Meanwhile, the group that benefits most barely changes from cycle to cycle. As with any structure that behaves like a pyramid, the biggest winners are the ones positioned near the top, the ones who entered early, or the ones who have the most control over how the rules are written. Banks earn interest on money that was effectively summoned into existence with a keystroke. Corporations raise debt and then use that debt to buy back their own stock, which artificially lifts share prices and channels rewards straight to executives and major shareholders. Politicians make promises today, promises of protection, payouts, and stability, knowing full well that the actual bill for those promises will be handed to someone else later. And then there is the average participant. You are the saver whose money loses purchasing power. You are the employee whose wages lag behind the cost of living. You are the person paying taxes into systems that will not deliver to you what they are delivering to the people currently drawing from them. You are the latecomer who is still feeding the structure long after most of the benefits have already been extracted by those above. This is why the comparison to a pyramid is not just rhetorical. Once you see how the flows work, it becomes very hard to unsee them. The global economy has not imploded outright because modern governments have tools that someone like Charles Ponzi could never dream of using. They can create currency by decree. They can enforce taxation at scale to guarantee inflows. They can even project military power to secure access to resources and keep the system supplied. Those tools give the structure durability. They make it look more legitimate, more permanent, more stable than a street-level scam. But the core architecture remains what it is. It requires endless new money. It requires endless faith. It requires constant outward expansion. And a structure that depends on permanent expansion will always eventually hit a limit because nothing can widen forever. When growth slows, when the base stops expanding, stress shows up first at the bottom. So, what are you meant to take from this? First, stop assuming that the financial system was designed with your well-being as its main objective. It wasn't. The system is designed first to preserve itself. Debt is not treated by that system as danger. It's treated as fuel. Inflation is not treated as failure. It's treated as the quiet price of survival. Bailouts are not treated as shameful last resorts. They are treated as normal tools. These are not glitches. These are how the structure maintains itself. Second, understand that actual resilience is not found in the official promises of that same system. Real resilience lives in things that can still function even when faith in the larger structure weakens. That includes your own skills, which cannot be inflated away. It includes the networks and relationships you can rely on directly. It includes tangible resources you can access, and diversified holdings that don't instantly vanish at the first sign of stress in the official markets. And finally, realize that financial stability for you personally is not something that arrives because a government steps in at the last moment to save you. It arrives when you understand the mechanics of the system and learn to step around the traps it lays. The global economy is not legally classified as a pyramid scheme, but in structural terms it mirrors one very closely. It remains intact only as long as the base continues to feed it. And history shows that when the base weakens, when the flow of new money slows, and when confidence finally cracks, the outcome is harsh. History does not literally repeat event for event, but it does rhyme. If you mistake a pyramid for a solid foundation and you build your future on top of that assumption, eventually that base will give way. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.